Oh, dude, come on. Your channel is called Market Crash 2018. Of course, you're going to be talking about market crash. What better time could you have picked but to call it on October 19th, 2018? Guys, I know it sounds, kind of crazy that I'm picking October 19th for a market crash. But contrary to the general belief, actually, markets don't crash all in one day. There's typically a smaller size sell-off that precedes the intensified sell-in, which typically, if we examine, let's say, a 1987 crash, takes over the course of a week or two. Okay, so why are we saying that tomorrow there is a high probability of a market crash? And by the way, just to clarify, okay, since I did say market crashes don't take place all in one day, there's a few reasons we're going to point out in this video. So if you're a trader, a day trader, a swing trader, you can probably find this information quite useful over the course of trading the markets in the next week or two. So we're basically saying that the market could begin crashing tomorrow, and we're saying maybe Dow Jones can drop to the extent of maybe like 1,000 points. So we're pointing to a beginning of the crash. We're seeing a much bigger drop that could be taken actually on October 22nd. So stay tuned. I'm going to show you the thought process. I'm going to show you some charts. I'm going to make some parallel comparisons to a couple of the crashes in the past. So here's what we are thinking. Contrary to the popular opinion, interest rates are not going higher. And we're saying charts don't lie. So check this out. Two simple questions. Why are the banking stocks crashing? Why do institutional investors keep selling them? If they believed that interest rates are actually going higher long term, wouldn't that be a positive for the banks? Isn't that the type of environment where banks' stocks are actually doing well? Well, we are looking at a chart of JP Morgan at the day of its earnings announcements. And the earnings announcement was great. Typically, JP Morgan beats or exceeds analyst expectations, and so it did this time. However, it's typical for JP Morgan to sell off during the day of announcement. So we've got the following chart right here from today, October the 18th. Well, it looks like, since we talk about charts a lot on this channel, JP Morgan actually made an effort to bounce higher, as it typically does after the earnings. We're examining the same situation. Last time it announced earnings, it actually had a subsequent run higher. However, this time, it struggles to break above the 200-day moving average. And when we see this, when we see the 50-day line getting pretty close to this 200-day moving average line, for those of you that are traders that's been around for a while, you know that that's called the death cross. The death cross generally points to a much further drop. So the question is this: if the earnings are so great and it represents such a great value stock, then why would institutional investors be selling it? Because everything on this chart, and I'm not going to go into all the details here, is pointing to a lower price drop in JP Morgan. And why would we care to look at JP Morgan? Because it's everybody's favorite. JP Morgan, and what I mean favorite by institutional investors, right? When they look at, all the valuations and why they should invest money and so on. So it's been institutional investors' favorite, JP Morgan and Bank of America. So you're going to say, well, this don't look that convincing. So, okay, Bank of America is the second financial stock that's favored among institutional investors. If JP Morgan did not convince you, take a look at Bank of America. This death cross, I can't even say it's even in the making. This is happening today, October the 18th. And once this thing's crossed, this is actually a very bearish sign. So we're expecting further sell-off in Bank of America shares. And if the two top banking stocks are selling off, maybe everybody's talking about increasing the interest rates, but we just don't see it happening. You may say, okay, well, if the interest rates are not going higher, isn't the stock market supposed to be going to all-time highs? Isn't that what the lower interest rates, isn't that what's been propelling the market to go higher for the last 10 years? Yes and no. We do believe the lower interest rates are coming. We don't believe in the higher interest rate environment, and we're going to give you a few reasons why. But in the meantime, while the Fed is certain that they're increasing rates in December and 3 more times next year, in combination with the current environment, we believe that the markets are heading temporary way lower. So here's what we mean by that. Let's take a look at a few more details. Actually, takes me to question number 2. Why is gold going higher? Generally speaking, if the interest rates are going higher, gold is supposed to drop. But gold has stopped to drop. And if we look at the charts, it's actually making quite of a bullish reversal here around, the 1200, 1230 level. And it has a very high probability of actually breaking above 1235. So we're getting 2 divergences. The banking stocks are selling off. We got gold that is being bought, which has not happened in quite some time. So we got investors getting bullish on gold, investors getting bearish on banking stocks. There is no shape or form does that equate to higher interest rates in the future. So maybe they talk about that all over the news, higher rates. But in reality, the reason why investors don't buy the story and their actions clearly state that they believe the interest rates are not going higher is because of this. Because the global economy is slowing. Look, I know sometimes here in the United States, we just don't pay enough attention to what's actually going on in the world. But take a look. Maybe you have missed this. Here's a Hong Kong Stock Exchange, okay? Fallen knife, okay? And the worrisome part about it is the fallen knife could actually accelerate the fall. See, Chinese and Hong Kong Stock Exchange actually has long time ago already formed this death cross. And you can clearly see what happens after that takes place. You're spiraling lower and lower and lower. Now, nothing goes in a straight line lower or higher, so clearly there's a sequence of highs and lows here, but the downward trend is lower. At some point, it actually accelerates to where we could see maybe some drops to the extent of 2,000 points, 3,000 points. It is coming. And as I'm recording this video around 6 p.m. on October 18th, 2018, we may actually begin a huge downward spiral in one of these exchanges overseas overnight. And you're going to say, well, what's the big deal? Okay, well, the big deal is United States stock market has been very resilient to everything that's been going on in the last couple of years. But it's not going to be resilient forever. You're going to ask me then, okay, fine, but this could be going on for a number of more weeks, a number of months, maybe a number more years. Well, we're not so convinced because when there's a number of signs that unanimously point to a drop, we think it's going to catch a lot quicker than what most of everybody believes. So here's a chart of Japanese stock index. Okay, it's actually had recently a failed rocket launch, what we call it, which is a bearish reversal in the making. And this chart does not reflect it, but actually today overnight it fell another 500 points. So the drop off, a huge drop off, is near in the Japanese stock market as well. Now, only in Asia that we have an issues? Well, it turns out clearly not. Look at even the German stock market index. Okay, we're observing a typical head and shoulders pattern, which is quite bearish. It really signals a huge drop off as well. Most of the world markets have been dropping now for a while. You have markets like Turkey, Greece that are already down 20% for the year. Not talking about Italy and Spain. And so here's what's happening. Okay, as these markets are falling, their currencies get weaker as well. And the demand for dollars and US treasuries actually gets stronger. Stronger dollar negatively impacts United States companies' earnings. And more importantly, it impacts the earnings forecasts for U.S. companies. The number one criteria when institutional investors decide whether to invest in a particular company or a stock is what are the future projections. And if the future projections are decelerating, that is definitely not a reason to buy the stock, but it is definitely a reason to sell it. So as many of the companies that we have seen this recent week, including Walmart, are decreasing their future forecasts, we're projecting that more than 80% of U.S. companies will be reducing their forecasts for the next quarter. And since we're just beginning the earnings season, we're fixing to get ton of companies, one by one, slashing their forecasts going from here forward. What does that mean? Lower forecasts drive stock prices much lower. Now, here's a much bigger problem with this. Okay, slower global growth and crashing foreign markets will actually negatively impact not just the United States market, but the underlying economy. U.S. will have to revise its GDP growth outlook. Revision in the growth numbers will cause the Fed to stop raising interest rates. Actually, we're thinking that there is a possibility of a new QE coming. However, at this point, we're not sure how the markets are actually going to react to the QE, because clearly that would signal that the economy is going pretty much to hell. So, but until that happens, because QE could be a positive thing, we just don't know how the markets are going to react to it. I think this time they will react negatively to it. But until the Fed actually states that they are not raising the interest rates, until any further announcements about the QE would be coming, we believe that the markets are heading significantly lower. How much lower? Well, S&P 500 trades today around 2,800. We think we could see S&P 500 in the next couple of months down to as low as 2,300, which literally would be just under 20% drop from where we're currently trading. If anybody remembers, 1987. Now, why would I bring 1987? Because I think the conditions, the market conditions, are very similar. Here's what we've got throughout the 80s. Okay, there's some main things that I think are very similar to the market environment right now. The rise in protectionism, the Reaganomics, the higher tariffs. At the same time, we're getting the global slowdown, and that's exactly what's been happening in the 80s. There's been a global slowdown that caused the dollar to go higher. Similar conditions that were noticed also includes rising trade deficit, rising budget deficit. Dollar's been predominantly stronger for most of the 80s. And we were in the environment in the rising dollar. Gold was actually not falling, it was going sideways, and it was increasing in value during certain years. Until the 1987 crash, dollar's been predominantly stronger. However, right before the crash, within months, the dollar all of a sudden was getting weaker. It actually hit a low on the dollar index, a low of 93. Well, guess where the dollar is at right now? It's at 94 to 95 range, so we're not very far off the 93 that we had back in 1987. Here's the main secret to the entire recipe. This right here, what you see on this chart, is actually what intensifies every market crash. Yes, it's the margin debt. It was the highest in the history in the 1929 market crash. It was later the highest in the 1987. And the highest it's ever been, guess when? It's right now, in October 2018. So basically, when they have a few days of the market selling off on strong volume, where they drop 1,000, 2,000 points a day, okay, institutional investors have no other alternative but to sell their stocks. And guess what kind of stocks are they going to be selling? Are they going to be selling the best stocks or the worst stocks? Well, you may be thinking they're going to be selling the worst stocks, clearly. Well, guess what? That is also a general misconception. They're going to be selling the stocks that are actually good stocks, like Amazon, Google, and so on. All the famous names. Why so? Well, because they're going to have to get rid of those stocks to meet the margin requirements. And because stocks like Amazon are 99.9% owned by institutions, by institutional investors. When all of them start selling at the same time, I'm going to give you a clue in just a few slides exactly where Amazon may end up next week. Well, there's a little clue here. Can Amazon crash to 1350? Here's the comparison. I'm going to take you guys briefly to February of 2018. Now that is February 2nd through February 9th, the week where the markets have been crashing 600 points, 1,000 points, 12 to 1,300 points overnight. So this is the reaction of the Amazon stock in February. As you can see from this high point right here, it dropped to a low point. This low point coincides with the lowest point in the indices around February 2nd through February 9th. So actually this low point was set on a Friday, February 9th, before the markets rebounded. So what is the importance of this? Well, while the markets were crashing 1,000 points or more per day in February, okay, Amazon stock actually dropped 14% during that time. As you can see, it promptly bounced off of 50-day moving average, which is what this blue line is on this chart. Let's analyze how Amazon reacted in April. Okay, here's the second time Amazon fell from this level right here, about $1,610, all the way to about $1,350. That is when Donald Trump was trying to increase United States Postal Service rates for Amazon, and all the drama was going on. This time, Amazon stock dropped 16%. And this time, it actually traded under the blue 50-day moving average line for quite a bit of time. Now, guess what happened last week? Amazon dropped 18%. Now, that's been the highest drop, but it's not the highest drop that is notable. Okay, falling from 2,033 to 1,687. It actually almost reached the 200-day moving average. It wouldn't be such a bad deal if it didn't do that on a much stronger volume than it did fall in February and April. On top of that, we're clearly noticing a double top right here. The stock is trading severely below the 50-day moving average. So a bounce at this point is not something that is highly probable where the stock can just jump and get above this 1921 level. Especially if you take a closer look and you see what actually happened today on October 18th, 2018. Amazon actually, after this drop, which I pointed out happened in very huge volume, it attempted to go much higher to a level of about 1850. It could not hold that level even for a day. It started dropping and actually dropped $61 today to reach a level of 1770. Looking at tons and tons of charts, when we're noticing a double top, okay, this to us right here looks like, I know a lot of people are going to look at this and going to say, well, this is an uptrend. The stock is uptrending. It's going to, it looks like it's going back up. And they're going to draw this line. Well, in our 13 markets move formula, we have a market move that we call market move 11. It strongly resembles this. And the market move 11, if we were to draw it out, it actually looks like Amazon could be reaching this level right here in the near future, which is $1,654. If the markets clearly are going to be dropping way below that, we easily see Amazon at $1,500 as early as next week. So can you picture Amazon at $1,500 next week? Here's what our 13 markets move sequence actually shows us could be taking place tomorrow. These numbers may not be meaningful to you, but they are to us. Move 3, 7, 11, 1, 10, 3. Move 10 is a very rare move, and typically in 90% of the cases, it is followed by two identical moves as far as the directional move. So today we actually had a move 3. Tomorrow we're expecting another move 3. And the move 3, to describe to a trader what that means, is when the markets actually gap lower, they proceed making new lows for the day intraday throughout the day. And that's exactly what we've had. Initially, markets didn't open lower significantly, but then they broke through this level of 2,800. Then they broke through this level of 28, 27, 85. And then they broke through this level right here. Okay, 28.60. Actually, 28.68 was an important level. If you take a look at the daily chart, that is where the 200-day moving average sits. So what are we saying? There's a high probability of a move lower tomorrow. And again, what do you want to short? Do you want to short bad stocks? Do you want to short good stocks? You want to short the stocks heavily owned by institutional investors. Why? Because when all of them have to meet their margin requirements, they all will be selling the same stocks. So this is one of these times where it makes sense to sell the best stocks. This is one of those times where it does not make sense to buy the dip in some of these great names like all the FANG stocks like Amazon and Netflix. Actually, if you haven't watched the video on Netflix, we pointed out on the charts a couple of days ago after Netflix announced earnings, when it was opening at 380s in the morning, we said it was going to drop. Today, Netflix fell to a low of 346. I promised I was going to do a follow-up video. I haven't had time to do it yet, but if you're curious, what made us believe that Netflix was going to drop after it initially rocketed way higher? Hey, check out this video. There should be a link for it somewhere at the end of this video right here. Guys, I know it's been the predominant pattern for the market to continuously go higher, and investors have been buying the dips. However, the market environment is changing, and therefore it requires a different strategy. So if you are a trader and you're wondering, why were you doing so well before, and why you may not be doing as good right now? Well, because you're probably still using the same strategy that you were utilizing before that got you good results. You're still using it now. There's one main little issue with this. The market environment is changing. So if you're applying the same old strategy to the new type of market environment, it's probably not going to work quite as good as it did before. So if you're looking for some answers, our answer to everything is the charts. We don't care about the news. We look at the charts, and we have a very simple 5-step process. So if the market does drop tomorrow, do yourself a favor. Rewatch this video one more time and sign up for our Charts and Patterns Recognition course. The links should be somewhere below this video in the description, and make this year your best trading year ever. Thanks for watching. I'll catch you in the next video.